A new regulatory review is sounding the alarm over the interest of investors. Canadian regulators suggest some clients are being offered products and services that may not be in their best interest. So how do you make decisions that are in alignment with your financial goals? Joining us now to discuss is Peter Sashecki from Everything Financial. Good morning, Peter.
Morning.
So we want to ask you first, though, about the interest rate announcement this morning. The Bank of Canada is holding the rate steady at 2.75%. To be expected, a lot of people expected that to happen. But what does that mean for investors or people who are looking to renew their mortgage and all sorts of things like that?
60% of Canadians are remortgaging in the next, this year, really. That means they're still going to be paying a lot more money than they were paying if they started that mortgage in 2020 or 2021, possibly up to 3% more than they were paying then. And as I said 6 weeks ago when we did the same question came up, the rates are still about 0.75% or 1% above where they really should be based on the ratio to inflation. And hopefully at some point, people who have those floating rates and home equity line of credits, et cetera, will get some breathing room, but not yet.
Yeah, the next interest rate announcement is September 17th, so we'll wait for that one. Okay, so let's talk more about this these regulatory review that suggests that investors are facing potential harm because of what appears to be high-pressure sales practices. So tell us more about that.
Yeah, the Ontario Securities Commission, and they did a study and interviewing the salespeople at the five big banks and the mutual fund salespeople, and it was them who came out. So the salespeople who said they don't feel like they're giving people the right product. They don't feel they're able to do what's in the client's best interest all the time. So it was kind of alarming, but good transparency as well.
Yeah, so this was done by the Canadian Investment Regulatory Organization and the Ontario Securities Commission, and it found that 24% said that clients have been recommended products or services that are not in their interest. So what kind of products would they be?
Well, that would be, a simple example could be one of two things. It could be, there's things called proprietary mutual funds. So XYZ bank person, employee, sells their bank's mutual fund instead of maybe a third-party mutual fund, which might be better suited for that client because of pressure, because of quotas, because of sales bonuses.
Because they are under pressure to sell those products,
That's right. And I don't think in a lot of cases, it might not be the person wants to do that, and that's why they're probably coming out and saying this, they're forced to do that, or it could be selling someone an RSP when maybe a TFSA is better suited. It could be something as simple as that, but a small tweak in what they're allowed to do could make it better and allow them to give better service to the client.
Another part of this study found that 33% of clients report that clients were provided incorrect info about products and services. So that could put a client at risk as well.
It could, but it might not too. Again, you can get a survey to kind of say whatever you want sometimes, but it could be someone giving wrong information. Like there's another study in there about not knowing exactly how to explain what a management expense ratio is. So giving the wrong information on that, or the person, through not necessarily any fault of their own, the salesperson, not knowing what all the fees are. So they're not giving complete information, where the fee structure, they might be telling them about one part of the fee, not the two other parts of the fee. So it's not that the person's investments are going to be in jeopardy, but they're just not being given complete information. And you know what? That's not fair. You should be able to have all the information so you can make an informed decision.
Okay, so what would be the rule of thumb then for people who are looking to have an informed opinion?
You really need to go to someone independent who is a fiduciary. So ask, are you a fiduciary? Fiduciary means they have to do what's in your best interest. And we know this, that the banks are not a fiduciary. They answer to shareholders, not to the client's best interest. And the people, unfortunately, the salespeople, are also answering to the people up above. So ask them for more information. Ask the questions. Why is this better than this? And ask them, how are you paid to recommend this mutual fund versus this mutual fund?
Then if you have all the information, then you can make that informed
and then you
opinion.
decide.
Yep.
And then it's your decision.
Peter Sashecki, Everything Financial. Thanks for joining us, Peter.
Thanks, Carrie.